Cap rates, what are they and how can you use them when investing in self-storage facilities? These are some of the things that we're going to discuss in this video. If this is your first time here, I'm Dr. Jeff Anzalone, a periodontist that's on a mission to teach you how to reach financial freedom by creating streams of passive income. If you're serious about achieving financial freedom, do me a favor, download the guide below. Let me ask you a question. What did your first cell phone look like? Was it one of those big bag phones like you saw in Miami Vice that Crockett and Tubbs used to use when they were driving around in the Ferrari? Or was it one of those big Motorola phones that were like the size of a brick? Needless to say, the cell phone industry has come a long way since the introduction of those earlier phones, right? And just like the cell phone industry, the self-storage industry has dramatically changed over the last 40 years as well, especially when it comes to the design and the amenities offered to their customers. Storage units of the past were real small. They were single buildings. They had very few amenities. They had like these roll up garage doors with little to no security. But then something happened. Americans started shopping online, which guess what? Gave them a much easier access to buy stuff, yet they ran into a problem. Where were they supposed to store all this extra stuff? Self-storage was the answer, but then something else changed. So instead of these self-storage units being tucked in behind some old barn out in the field, they're now located where? They're in heavy traffic areas alongside grocery stores and big box retail. Real estate investors have also seen an uptick in their value as they become more modernized. I recently traveled to Dallas and noticed several actually multi-story self-storage facilities. These things were so big, at first I thought they were apartment buildings. And as you can imagine, because of this extreme demand of people buying and storing stuff, self-storage can be an excellent investment choice. Typically, these storage facilities, they cost much less than apartments and they can be purchased with a smaller amount of money versus some of the other asset classes out there. Now, whether you choose to become an active or a passive investor, it's really crucial to understand the financial metrics involved, such as what we're going to talk about today is a cap rate, which basically is nothing more than something that's used to indicate the rate of return expected for a particular property. Cap rates have become increasingly more and more important to self-storage developers as the industry itself becomes more competitive. So let's start off by answering the question, what exactly is a cap rate? So a cap rate is a metric used to evaluate basically evaluate the profitability of a real estate asset, such as what we're talking about today, self-storage assets. Investors use cap rates to quickly compare the return on investment on these properties, which could vary by rental rates, construction type, location, and some other things as well. It's also an indication of what return an investor is willing to pay when acquiring a self-storage property. So typically speaking, it's this. The lower the cap rate, typically the higher the value or the higher the sale price. On the flip side, the higher the cap rate, the lower the value or the lower the price. Now, one other thing to consider is that cap rates don't factor in any debt service like mortgage payments, as because it assumes it's like an all cash purchase of the property. Let's talk about the next question. How are these cap rates, how they use? Now, some investors rely heavily on cap rates and they look for properties with cap rates of 8%, 9%, or higher. However, just you have to remember that's just one data point on an asset. So cap rates typically don't take into consideration other factors such as loans and the time value of money. Now, when comparing different properties in the same market, cap rates can be very useful as well. As an example, so if you're looking at and investing in some self-storage units and they have a cap rate, let's say of 7%, and then you start comparing other properties that have cap rates of 6.8, 7.2, and 7.4%, then you can be kind of rest assured that your property's cap rate is fairly comparable based on these other numbers of the ones around that in your area. Now, a red flag could be if some of the other properties have multiple points higher or lower than the others in the area. Cap rates can also be a good general measure of the asset class and corresponding risk in general. So assets with high cap rates, typically tend to be in developing areas, and those with lower cap rates are maybe in more kind of established areas. Now, as with most investments, higher rates means what? Higher risk as well. let's talk a little bit about how we actually calculate these cap rates. And what you do is you basically take the net operating income. So that's all the income minus the expenses. That's a net operating income. And you divide it by the market value or the sales price. And that will give you the cap rate. So uh, if if for instance the net operating income isn't provided, again you can just take the income generated by the whole facility. So if it's a self storage facility, you look at the rent. If they're having to pay for the locks, boxes that they store stuff in, U-Haul, I mean anything like that. That's all the income that facility is generated, and then you subtract out the operating expenses, maintenance, repairs, landscaping, taxes, insurance, payroll, all of that. That's going to give you the NOI. So let's talk about a cap rate example. So let's say that Dr. S, he's starting to feel the effects of practicing dentistry. Okay, his back hurts, his neck hurts, and he decides, you know what? Instead of seeing all these extra patients, I want to get into real estate investing instead. So he's heard that the self storage asset class is the place to be, and he gets in touch with a self storage broker for help. Now, this broker, he goes out and he finds a self storage facility that actually has a gross income. Remember, that's the total amount of income coming in of $200,000. The expenses on the property is $75,000. So he determines that when he takes the gross income and subtracts out the expensive, the NOI, the net operating income for this facility is $125,000. All right. So his broker informed him that, again, comparable self storage units of similar size, condition, in that location are roughly selling at about a 6.5 cap rate. But again, he comes over here looking at the comparables. You're looking at 6.5 cap. So for him to figure out what the proper sort of value or sales price would be, he would divide the NOI, okay, the $125,000. He'd divide that by sort of the comparable cap rate, 6.5%. So 125,000 divided by 0.065, and that it comes up with 2 million. So now he's able to determine that sort of the rough value of that property based on everything that's out there, the income, the expenses, the location, should be around about 2 million bucks. So if you were to look at this actually in reverse, and instead of him buying a facility, if he was selling the facility, let's say he already owned this and he wanted to turn around and he wanted to sell it for 2 million, okay, and he wanted to determine the cap rate, again, he would just take the NOI, the 125, remember, 125 NOI divided by what? The sales price or value, $2 million, which would come up with the 6.5%. So let's talk about the 3 reasons why cap rates are used in these self-storage transactions. Number 1, it's because of potential income. So these properties have their value based on their income potential along with the perceived risk of maintaining that revenue. Number 2, versatility. So because a cap rate is considered income only, it can be used to compare other real estate types along with other alternative investments like stocks, bonds, and businesses. And then number 3, comparables. So you need a method to compare properties with different locations, physical conditions, and level of management, as guess what? No 2 self-storage properties are exactly alike. So depending on the level of risk involved in maintaining a facility's future income stream, the cap rates are either adjusted up or they're adjusted down. So let me give you 2 examples that could kind of help visualize this concept. We're going to talk about self-storage A, we're going to talk about B. So self-storage A, all right? This is an older facility. It's about a 20-year-old facility. It's out in the boondocks. It's out in the country. There's no on-site management, and it's actually at a 8% cap rate. Okay, let's talk about the risk involved in this. So the risk involved because of where it's located. So there's plenty of land out there. There's plenty of adjacent land for competitors to come in and build on. Okay. Also, it's 20 years old, so it's basically it's an older condition, potentially run down. And then number 3, again, because of its location, it's out in the middle of nowhere, typically in the area, low population. Now let's compare that. And again, it's 8%, 8 cap. So that's a higher cap rate, right? So let's talk about one with a lower cap rate. All right. Self-storage B. This one is newer. It's only 2 years old, and it's actually located in a booming suburb of Dallas. And it comes with an on-site manager. This one didn't have an on-site manager. And it's got several amenities such as climate controlled storage. Its value, it's a lower cap rate, 5.25% cap rate. So the upside to this site is the number of customers it actually acquires each month due to what? The population growth that's coming into the area. It's not out in the middle of the country. Also, it's 2 years old. It's newer construction that's professionally managed with limited barriers of entry for competitors. Doesn't have all this adjacent land. So now you can kind of see the comparable, how you would go back and forth to compare between two facilities and how you can come up with a cap rate. So let's talk about some other factors that either demand a higher cap rate or a lower cap rate. So here's some that are demanding a higher cap rate, thus a lower value. Okay, kind of like the one out in the country. So poor visibility, low occupancy, no on-site management. If the area has declining population, high competition because there's areas for somebody to come in right on top of them and build. And then typically there's no security. There's no security guard, cameras, fences, things like that. People like to feel safe not only for their stuff that they're saving, that they're storing, but also whenever they come into the facility, they want to feel safe and secure. Now let's talk about some factors that actually lower the cap rate, thus increase the value. So excellent visibility, excellent access. Again, newer construction, professional management, typically on-site management. Well, if it's laid out good, high occupancy, and typically low delinquencies. So as with any type of real estate asset class, self-storage cap rates, they go up, they come down as the market cycle evolves. But in the last 15 years, we've actually started to see a decline in these rates, mainly due to the fact that the self-storage industry has really proven resilient. And we've particularly been able to see this firsthand in both the 2008 economic downturn and more recently in the 2020 pandemic. Now, even after these major financial setbacks for the US, self-storage has continued holding its value as collections continue to remain high. Many investors are taking note of this industry as providing is typically a more stable form of cash flow than when it had less of a history behind it. Now it has much more history behind it. So even the big players are getting into this game as more of their capital is starting to enter the market. So you may have heard that some of the institutional investors, such as, you're probably familiar with this, Blackstone. You probably heard of Blackstone. They're actually starting to invest in self-storage. So actually back in 2020, Blackstone invested 1.2 billion with a B in a company called Simply Self Storage. And Simply Self Storage is one of the top 5 private owners of self-storage facilities in the country, and they operate a very high quality portfolio of these self-storage facilities totaling 8 million square feet across the US. So many of these big players are often overpaying for these properties, basically just for the sake of diversification. And in turn, it's increasing values, and increasing values tends to drive down the cap rates even more. Something else causing cap rates to decline or causing them to compress is the increased diversification of the self-storage industry. So we're beginning to see more income options, such as tenants, insurance offered to tenants, which is something that just the last few years didn't exist. And these facilities are now beginning to require this tenant insurance, which again, what does it do for the owners? It increases their net operating income, right? And their value in the long run. So more people are learning about investing in the self-storage market as a way of diversifying and mitigating risk in their portfolios. As this continues, you can expect to see an increase in the cap rate compression. In turn, this is going to make it harder for you and me and all the other investors to earn double-digit profits that so many people early on have realized. Also, it will make it even more important for you to partner with developers and operators who understand the self-storage industry. And speaking of partnering with people and speaking of developing things and developing strategies, do you have a strategy? Do you have an investment strategy? Well, That's exactly what we discuss in this video over here, where I talk about a particular person, how they should set up their retirement strategy, and I give you a couple examples of some. So I'll see you in this video.